Hello, Adrian Botham here again from howtoinvestinshares.co.uk. The subject of this video is what is a stock exchange? Now, stock exchange and stock market are very similar terms, very similar concepts. But to me there is a slight difference, and that is a stock exchange is a mechanism or a system or method for actually swapping or doing the act of buying and selling our stocks and shares in the market. Stock exchanges were born actually many years ago, and it was brought about initially by traders who were shipping their goods overseas, wanting to get some security or insurance for the trade. In those very early days, shipping was a very dangerous business, a very risky business. Putting your goods on a boat and then letting it set sail, it could be weeks or months until it got over to the other side of the world, and the trader therefore wanted some sort of method of making sure they didn't lose all their stock. So they would insure the stock. Then an insurer, that's a lot of money in one big sum. They would essentially break that up into smaller pieces and issue that as a smaller piece or a bond, an IOU, to an investor. So basically this was a mechanism of actually getting a number of investors to put up money for a shipment. Now it was many years later when a company wanted to do the same thing and get investors on board. So it broke its company up into shares. That's how bonds and shares are slightly different. And it was back in 1760 when the first stock exchange was formed in the city of London in the UK. In those days, these bonds for all these shipping trips I mentioned, all that kind of transacting, typically done in a number of coffee houses in the city of London, would you believe? And for shares, the focus was a particular coffee house known as Jonathan's Coffee House. But it wasn't until 1773 when the place was renamed as the London Stock Exchange. And at the time it was the first example of a stock exchange in the world set up to trade company shares. Now, although the London Stock Exchange is the first ever stock exchange in the world and therefore is the oldest, it is no longer the biggest. The biggest is the New York Stock Exchange, formed at 11 Wall Street in New York in 1792. Stock exchanges in those days were essentially physical markets. So in order to trade, you had to be physically at the market. However, with the advent of computers in the 20th century, nowadays it's computers that do the physical trading and exchanging. There's no need for people to be physically on a trading floor anymore, like they used to be in the early days. And in fact, it was the NASDAQ in 1971 that was formed as the first ever fully computerized stock exchange. So the NASDAQ didn't need a location like the London Stock Exchange or the New York Stock Exchange. The NASDAQ, right from its inception, was an electronic only trading platform, and in order to keep up with the NASDAQ, all these other stock exchanges I've mentioned already and many others in other countries around the world have needed to computerize. The advantage of an electronic exchange, of course, over a physical stock exchange is that the dealers, the brokers, the market makers, the people who trade the shares in the market, they don't physically need to be at a given site. They can trade electronically. and they can be remote from the physical place where it used to take place. The other major advantage as an investor is it's all done electronically, and therefore it's a lot slicker, a lot quicker. It's instant, pretty much instant nowadays, and you can see this information online, and hence why there's been a massive growth in online brokers for buying and selling shares. So that's it then for this video. I hope you found it useful. As I said earlier, my name is Adrian Botham from howtoinvestinshares.co.uk. I've got lots more information on my website as well as a free guide. So I hope to see you on a future video. Until then, bye bye for now.